In the last class, we have completed section 17, class 2, subclass 1, 2, 3, 4, and 8. In this class, we have to complete 4 classes. Subclass 5 is all about if premium paid on implies life assurance or annuity, then it is actually taxable. Employer, employee, with that insurance company, okay, life insurance company, for his life or for his periodical benefit after retirement, employer has paid a premium. Employer had paid a premium. This premium is also taxable perquisites. Probably it may be around 50,000 rupees paid for employee's benefit, then it is taxable. Now, instead of it is for particular employee, employer paid for all the employees put together. All employees put together for their benefit. Premium is paid uniformly. Even for accident. Okay. Accident coverage. During the work environment, there may be happening some accidents in manufacturing sector, right? So by the time that should be compensation for the person affected. For that, employer has paid the premium for LIC and LIC releases the payment to the employee. This is common for all the employees. And this may not be not only LIC, maybe PF or superannuation fund or any other group insurance scheme or ESI, employee state insurance. So ESI is nothing but amount payable by the employer for the ESI scheme. For medical treatment, they can simply go and avail the benefits from ESI. There may be ESI hospitals or compensation may be given. So in Trichy also nearby National College, there is a hospital called ESI hospital. If you are being the employee, employer contributed small amount as premium or whatever it may be for your benefit. And you may get the card, ESI card. So go there and get treated yourself at free of cost, or the nominal value will be there. Sir, in my particular locality, I don't have the ESI. Then what can I do? I can go and get treated some approved hospitals, and you can get the reimbursement from the ESI for the safety and security. If all this done as a mandatory requirement, then these things will not be considered as perquisites. So other than that, any premium payable for a specific employee for life insurance or annuity benefit will be always taxable. Life insurance or annuity. PF, approved superannuation fund, SAF. Superannuation is nothing but retirement. Okay, usually superannuation, no. After the retirement age, they will be working for a couple of months or period extra. Okay, for that any benefits is payable, no, may be called as a superannuation fund. Also be considered as retirement. If a teacher has the retirement date, probably mid of the annual year, probably exactly on November 1st week, suddenly changing the teacher will be a trouble for the students, right? So the teachers will have the period to enjoy for the remaining period. So up to May he can serve, so that a batch can be completed comfortably. Changing the teacher halfway through of the classes will be really tough for the students. So in order to that, they will extend the period. Usually they can enjoy for the remaining period. Even if the retirement period being 31st July, just 1 month is over after the class, still they can enjoy remaining days, right? And group insurance, ESI, fidelity guarantee scheme, all these things will not be considered as perquisites. And of course, this may be eligible for section 80C benefit. Okay. The amount premium paid by employer for the employee's life insurance or annuity can be claimable as deduction under section 80C. 80C, as it is your income. You have seen that professional tax. No, if you are receiving the professional tax, it's a part of salary. And of course, can be claimable as deduction to section 16 class 3. Same way, the premium will be considered as perquisites forming part of the salary, and you can claim that being the deduction to section 80C. And personal accident insurance premium will always be not taxable. Okay. The judgment is given in the case between CAT versus Lala Sridhar. Okay. So with that, the fifth one is over. Beyond that, nothing is there. And the sixth class is all about sweat equity shares. Sweat equity share. Sweat equity share is nothing but the equity shares offered to the shareholders, employees for their loyalty as well as their technical know-how support, specially given in addition to the regular employment work they have done. In order to honor them, the employer offers shares at much discounted value. The market price may be 100 rupees. The offer price may be 70 rupees. 30 rupees discount is there. Right. That 30 rupees discount is that is called perquisites under section 17 class 2. Clear? The average fair market value minus amount received. The market value is nothing but the fair market value may be 100, but amount recovered is only 870. So the difference between 30 rupees is the perquisites value with the number of shares offered. That's what about the sweat equity shares. Okay. So in Singar Academy text, right? So related to the sweat equity shares calculation, I have given a big list. No need to worry about that list. Okay. I'll just brief, but of course you can nicely skip this one for your purpose. Sweat equity shares taxable to all employees. What about the fair market value, sir? Fair market value is nothing but opening price plus closing price divided by 2. If the share is listed and traded in the market regularly, and at the last trading session, see the opening price of the share and closing price of the share and take the average. That average will be considered as fair market value. From there, any amount recovered, usually a normal amount is recovered from the employee, that will be subtracted, balance will be the perquisites multiplied with the number of shares, multiplied by number of shares. Okay. Now, whatever the share may be, Indian Oil Corporations, we'll take this one. Today, there's a market. Okay, Saturday, Sunday, and government holidays, we don't have the market. If the share is allotted by today's price will be the base. Open price being 147.50. That's what about the market opening price. Market opens at 9:15. By the time what's the first traded price, that will be considered as open price. Market closed by 3:30. By the time, what could be the price? Okay. That's what about the open, high, low, and this is a previous close. I need today's close. I assume this will be the today's close price, 149. Okay, this will be the today's close price. So you have to add the opening price as well as closing price and take the average of that if it is traded. Sir, if it is not traded today, the day of allotment, yesterday's trade can be taken, or even a weeks before, the latest trade rate can be taken. Clear? Price in recognized stock exchange as on the date of exercising the option will be taken. Note, sell price is taken if sell and buy price both are given. If sell and buy both is given, then sell price will be taken. No trading on the date of exercising the option, then what you have to do? Fair market value is the closing price and the closest to the date of exercising the options, closest to date. Okay. If no market is market is open today, 3 days ago only available, the 3 days ago's last traded value, closing value will be taken. If listed in more than one recognized exchange, we have NSE as well as BSE. It is traded in NSE as well as BSE. What can we do? Closing price on a stock exchange which records the highest volume. NSE, National Stock Exchange, and BSE, Bombay Stock Exchange. The share may be traded in NSE as well as BSE. In NSE, it may be named as, it is traded at 149, and BSE, it is traded at 148.9. What value you can take? So, the highest volume in NSE, the number of shares traded being 10 lakh shares, and BSE 4 lakh shares, then this will be predominant one. Okay. See here. So we have been given the values here. This is 149.04 will be the NSE market rate. BSE market rate being 149.15. So in NSE the rate is cheaper and BSE the rate is higher. Then you have to check the volume. In BSE the volume of share being 3,42,000 and in NSE the volume being 93 lakhs. Usually NSE is superior. Usually the trade happens in the NSE almost manifold, maybe 10 to 20 times higher than the BSE volume. So naturally this will be taken. 93 lakhs 31,000 shares traded in NSE. So NSE rate 149.04 will be taken. Is that clear? But this particular part, no, very rarely asked at the inter level, but of course may be very important final level. So you no need to worry about this one. Unlisted shares, if the shares is not listed, not available to be traded in NSE or BSE, what we can do? And specified securities not being shares, other than shares, then you have to decide the value based on the merchant banker on specified date. The specified date is nothing but date of exercising the option or not exceeding 180 days from the date of exercising the options. Okay, when you exercise, no, they from there 180 days within that period, if you get any valuation certification regarding that particular security not being the shares. So ESOP or sweat equity shares not necessarily being shares, it may be preference shares also not listed here. Preference share also. This part is not required. Now XYZ company and Mr. A. XYZ company offers him shares. 1,000 shares offered at rupees 80 each. The market price of the share being 150. Okay. The date of offering being 1/4/2024. On offering in Mr. A's book, the difference between these two is called salary income. Under salary, they have n number of basic, DA and all. Apart from that, perquisites, sweat equity shares. This value being 150 being the market value or fair market value. Minus the amount recovered 80 multiplied with the number of shares 1000. So 70 into 1000, 70,000 rupees is part of salary. Sometimes later Mr. A sells this to Mr. B. Okay, this share is sold to Mr. B for rupees 170. The sale price being 170. What happens? The moment share is allotted in the hands of Mr. A, this is the property for him. The share being the property means asset. If it is asset being on transfer of the asset, then automatically it falls under capital gains. It will fall under capital gains. So we have 5 heads of income, one of them being salary. Next, income from house property. Next being PGBP, and another one being capital gains. So now, as it transfers that to Mr. B by 15/7/2024, in a matter of 3 months after, 3.5 months after. So this will fall under capital gain. That too, the period of holding is very short, so it will be called as short-term capital gain. In this case, the sale price being 170, the cost of acquisition. What is the cost of acquisition for him? At what rate he purchased? You think the purchase price is 80? No, actually the purchase price for the taxation purposes, the actual fair market value will be taken. Is that okay? Because the difference is considered as his own income. He already considered this part of his income, means that will be a part of the purchase consideration. It's not 80 is the purchase consideration, 150 will be the purchase consideration. Later on it is sold to B for 170. The difference between these 20 will be called capital gain. For 1000 shares, 20,000 rupees. So you have to add the salary income and capital gain income together with it will be gross total income for the taxable purpose. Is that clear? This particular sweat equity shares you will study in capital gains chapter also. Here we are studying in the salaries perspective. There we are studying under capital gains perspective. Both are interlinked here in basic model. Okay, basic illustration. Clear? Now, we'll see the illustration along with the capital gains later. Now we'll move on to the next aspect. Here is AS Company Limited allotted 1000 equity shares to Sri Chand. AS to Sri Chand. On June 2024, the shares allotted at rupees 200 per share. Amount recovered 200. Okay, consideration. against the fair market value being 300, number of shares being 1000 shares. On the date of exercising the options by the allotee versus street chand, the fair market value was computed in accordance with the method prescribed under the Act. So this 300 is also calculated as per the method prescribed. The method we have already referred. Of course, the method is not required for the inter, but having a slight idea about that will give more confidence. What is the perquisites value? The perquisites value is nothing but the difference between these two, 100 multiplied with the number of shares. So 1 lakh will be the perquisites value. In case of subsequent sale of those shares by Street Chand, what will be the cost of acquisition of those sweat equity shares? What could be the cost of acquisition? Cost of acquisition is equal to the fair market value. Fair market value, which is equal to 300 per share. 300 into 1000, 3 lakhs will be the market, means cost of acquisition. If he sells later on beyond this, will be gain. Sells lesser, then it's a loss. That will be studied along with the capital gains chapter. Let's now move on to the next one. The last part. The last part. The last part. So we have completed schedule 5 and 6 also simple concepts. Now we have to deal with 7 and 7a. 7 and 7a. Listen carefully. This particular part. 7 and 7a. 7 and 7a. Superannuation fund. Employer, employee. So employer deposits. Employer works for employee. Sorry, employee works for employer. Service is there. Employer offers him salary. Probably monthly 1 lakh. Apart from that, employer deposits in PF account at the rate of 12%. If he deposits 15%, what happens? 15,000 rupees is deposited. And equivalent 15,000 is recovered from the employee also, which is also be deposited. Clear? Now, you know that any amount contributed by the employer for the employee's PF, that too recognized PF, exempted to the extent of only 12%, beyond that will be taxable. Isn't it? Recognized product. How much is exempted? 12%. 12,000 is exempted. Beyond that, 3,000 is taxable. Clear? Instead of that, the salary being 10 lakhs per month, then 12% could be 1 lakh 20. He deposits almost 1 lakh 10,000. How much? 11% per month. So 1 lakh 10,000 is deposited. Exemption limit is 12%, 1 lakh 20. Totally exempted. Nothing is taxable. Nothing is taxable. Is that okay? As 1 lakh 10,000 being the per month value for 12 months, how much it should be? 13 lakhs 20,000 rupees. Employer's contribution alone. So the employer's contribution to the recognized provident fund is within the limit what we have already referred in PF, 12%. But overall total value exceeds 7.5 lakhs. No. Anything exceeding 7.5 lakhs will be considered as perquisites, also be taxable. So here up to 7.5 lakhs is exempted. Beyond that, how much is that? 5 lakhs? 70,000 becomes taxable now. Is that clear? So 5 lakh 70 will be taxable hereafter. Up to 12 percentage. If it is beyond 12 percentage, already disqualified as per the PF provisions we already studied. In case of RPF, in case of statutory provident fund, completely exempted. Forget about that. But as per the perquisites provision, subclass 7, overall contribution by the employer to the employee put together may be recognized provident fund or new pension scheme or whatever it may be mode. All these things put together restricted to, there's a cap, not beyond 7.5 lakhs. If it is beyond 7.5 lakhs, that excess amount will be considered as what? Perquisites. Not only that, not only that, that excess amount carries interest, right? Interest on this amount up to 9.5% is exempted. Beyond that is taxable, right? Now, even though it is less than 9.5%, interest on this amount, no, that also be disqualified and taxable. Though it is only 11%, 11% interest is offered on this, or 10% interest is offered on this, which is 57,000 rupees. So the interest rate offered in this case is 10%. You know that. You know that. Up to 9 interest rate, instead of 9%, I can make it 9%. What is the value here? 9% and this value. Come on. 51,300. What is the interest here? For 7.5 lakhs to the extent of limit. Nine percentage, 6,67,500. Oh my God! An answer I can calculate myself then. 67,500. This one is pretty within the limit, so it is not taxable. For the disqualified amount, no, further interest is also addable, no, that part also be taxable. Whatever the amount available there for the disqualified portions, on that interest is there, no, the complete interest is taxable, and that will also be subsequently carries interest, that is also be taxable. This interest accumulated the next year for this again 9% you will be getting, that is also taxable. Interest on this one is also be taxable. This interest carries interest in the next year, that is also be taxable. Interest and dividends on the above fund also be taxable. Clear? So first of all, if it is more than 7.5 lakhs, that 7.5 lakhs excess amount, this 5,70,000 will be taxable. Interest on it being taxable. And if this fund is there accumulated and kept in a separate account, that will be kept in separate account. You have to segregate. While depositing in the PF, no. The PF department segregates to the extent of 7.5 lakhs separate and beyond that separate. Anything beyond 7.5 lakhs is kept separate account. That will be totally taxable, and interest on that and interest on interest in subsequent year, everything will be also taxable. Okay. Interest on it is taxable. How it is going to be valued? Separate account is maintained. Now, let me explain this now very easily. Try to understand. So, if you refer your CA or CMM institute material now, you find this calculation. This formula seems to be pretty massive. Right. So, no need to worry about that. I will make you understand this very easily so that it will be very comfortable for you then. Okay. Now, let's try to solve this illustration. Try to solve this illustration. Mr. X is appointed as CFO of ABC Limited in Mumbai from 1/9/2022. 1/9/2022. His basic salary being okay. Basic salary being 6 lakhs. He is paid 8% DA and he contributes 10% of his pay and DA towards RPF. Company also contributes the same amount. What is the amount contributed by the company? 10, which is very much within the limit, up to 12%. 1/9/2022, basic 6 lakhs, basic 6 lakhs, DA 8% on this. How much is that? 48,000. What about the total salary? 6 lakhs 48,000 per month. DA being 10% on this, 64,800. The accumulated balance in RPF as on 1/4/23, 1/4/23 and 1/4/24 and 31st March 2025. So you just think over 64,800 may be the DA contributed by employer as well as employee. 64,800 2 times may be contributed. His own contribution, employer's contribution, both put together. Since this date to this date, how many months he worked? From 9 onwards, from 1st September onwards. September, October, November, December, and another 3 months there. 7 months he worked. Multiply with 7, what's the value you get? 9 lakhs 7,000 something, right? But the balance as on this date being 9 lakhs 81,137. What does it mean? May include interest. Interest could be of average value invested, because 9th month end you invested around 64,800 and 10th month end and 11th month end and 12th month, January end, March end, February end and March end. The September month end investment carries 6 months interest, and next month investment carries only 5 months interest. The last month contribution carries no interest. What can we do? We can take the average. 3 months interest for all. Average. That's how they might have calculated. I am not aware about what is the real rate of interest here. If you want to find out, then of course you can find out. Anyhow, this is the amount available in his own RPF account as on this date, 9,81,137. Thereafter, the value increases to this much. How much is that? 27,43,048. And in the last year, it increases to 46,48,555. This will be the value he has. Compute the perquisites value chargeable in the hands of Mr. X under section 17 class 2 subclass 7 and 7A for the assessment year 24-25 for this year, 24-25 and 25-26 for this year. Now, what about the disqualified amount in the very first financial year, 22-23? Probably here 64,800 may be contributed per month. For how many months he worked? Only 7 months. For the 7 months, what is the value contributed here? 4 lakhs? 600. The contribution made in RPF in the financial year 22-23 is less than 7.5 lakhs. Nothing is taxable. What about in this period, sir? In this period, 64,800. What about the employee's contributions, sir? Never bother about the employee's contribution. That employee's contribution already included in his taxable salary. He already paid the tax. Taxed amount he either spends or invests. That doesn't matter. The government will not care about that. So, in case of employer, then the question rises. In case of employer, his contribution is restricted to 12% or overall contribution should be restricted to 7.5 lakhs. Here, the contribution by the employer is 10%, which is very much within the limit of 12%. No problem there. Now my question is, what about the overall contribution done by the employer over the year period? So here, this value being 64,800 for how many months? 12 months. Come on, tell me what's the value. 7 lakhs, 77,600. As this value is more than 7.5 lakhs, excess of that is first of all disqualified under section 17 class 2 subclass 7. How much is that? 27,600 is taxable, and here also 27,600 is taxable. Is that clear? First part is over. First part is over. First part there is no any doubt. First part there is no any doubt. Only the second part, interest on such one, and any interest you receive on this, and on that also you will get interest subsequently, also be disqualified. That may be calculated here now carefully. Is that okay? Shall I go for that now? Now what happens here? For the calculation of interest component to be disqualified, interest component. Clear? Interest component to be disqualified. Here 27,600 flat disqualified because the contribution by the employer for his recognized provident exceeds 7.5 lakhs. That excess amount is disqualified. It happens in 23-24 as well as 24-26. Surprisingly, there is no change in the salary. If there is a change in salary, then our headache will be still more. It's very simple. 27,600, 27,600. Now I am going to calculate the second part. What about the interest component? What about the interest component? For the calculation of interest, I need to use this way. Right. What about the disqualified amount in the previous year? What about the disqualified amount in the previous year? So here they have given a formula, like I'll just write the formula here. PC by 2 into R plus PC1 plus TR1 into R. Okay, this is how we can use the formula here. PC1 plus TR1 into R. Is that okay? Now, I'll brief what does it mean. Present contribution, disqualified contribution is invested month after month. So, we cannot calculate the rate of interest completely. Then how can we calculate? Very simple. We can take the average. You invest periodically for the first month 10,000, second month 10,000, third month 10,000. Such a way 12th month 10,000 rupees. First 10,000 carries almost 12 months interest, and this will carry 11 months, and this will carry 1 month. Or if it is being the mid of the year, maybe around 11.5 month interest, and this may be 0.5 month of interest. What can I do then? Take the average of this. 11.5 plus 0.5, 12 by 2, 6 months. It means just a half. So this 27,600 invested, disqualified investment, how much interest could be. So if the applicable rate of interest being 10%, you can calculate 10%. But what that but? This 27,600 disqualified amount is not invested in the year beginning. It is invested over the 12 months period. As it is over the 12 months period, the first month investment carries, disqualified amount carries 1 year's interest, last month carries only 1 month or half month interest. So, it is better to take half. Better to take half. What is the value you are getting? 1,380. 1,380. That's how we can calculate this part. PC bar 2. Present disqualified contribution by 2. Present this year. Present disqualified contribution by 2 into rate of interest. Okay. What about the PC1? Earlier disqualified contribution. Last year disqualified contribution. Not only that, total revenue for that in the previous year. Both amount put together, on that interest is also be calculated. That amount is also disqualified. This is the second part. Is that okay? Let me finish up first. This part will not be applicable for the first year calculation because there is no any disqualified in the previous year amount, 0. So this is 0. And what about the revenue on the disqualified amount? Already the disqualified amount itself 0, interest on 0 is also 0. Only in the second year onwards, this will carry value. For the first year, nothing will be happening here. Clear? So, very first year, you have PC bar 2 into R. Present disqualified contribution by 2 into rate of interest. And subsequent period, the first block will be the same for the current year's disqualified amount. And previous year disqualified amount, interest on that will be kept separately in a new block. On that interest is there, no. That will also be considered as disqualified. Two values will be disqualified from the next year onwards. Now, I have given the RB, rate of interest being 10%. Actually, it is not correct. You have to calculate the rate of interest also. How can you calculate rate of interest? Let's see the calculation of rate of interest. How can I calculate the rate of interest? The R can be calculated. The R can be calculated. Calculation of R. Okay. You have to calculate as a missing data, hidden information like you can calculate. What about the closing value? Closing value. From there, if you subtract what? Opening value and contribution, you will get the interest or return. You will get the interest. Is that clear? For the year 23-24, what is the closing value? 27 lakhs, 43,048 closing value. What is the opening value? 9 lakhs, 81,137. What about the today's contribution? This year's contribution. The amount contributed in this fund being 7,77,600. 7,77,600 by the employer, equivalent amount by the employee. So multiply with the 2 and get the value. Come on. 15,55,200. So opening we have 9,81,137. Employer and employee put together contributed 15,55,200. And the closing value becomes 27 lakhs. How it is possible? Only due to the interest. Three components will be there. One is employer contribution, another one is employee's contribution, another one is interest on these two. We know these two values, opening value and contribution. So closing value also we knew here. So we can calculate the interest easily. Come on, tell me the interest portion here. You have to subtract these two from here. How much? 2,06,711. That's what about the disqualified amount. That's what about interest. Now what about the average investment? Average investment. How do we calculate the average investment? Opening plus closing by 2. Come on, get the value. 18,62,093. Now find out the rate of interest here by using these two. Clear? Clear? You represent in percentage. You have invested 16,62,093, but your interest revenue being 2,06,711 over this. Then what could be the hidden rate of interest? 11.1%, 0.111. Otherwise, percentage no. You can convert that into percentage by multiplying with 100. So 11.11 is the value. Clear? Are you getting this? So here you just see in the very first year, present disqualified contribution being 27 and on that applicable disqualified interest being 11%. But anyhow, it's a present disqualified amount, no, may not be invested 0th period, invested over the period. So I have to take only average of this. What about the past year's disqualified contribution? In the previous year, we don't have any disqualified contribution. Not only that, as that disqualified contribution is 0, interest on that disqualified contribution should also be 0, multiplied with the rate of interest 11.11 percentage. Ultimately, this value will be 0 only. Come on, find out the total disqualified amount here. 1532 will be the disqualified amount. So, oh, this one is 27,600. Okay. So, disqualified amount being 1532. So, 1532 is disqualified here. This is as per section 17, class 2, subclass 7. This is 7A, interest on such income. The interest on such income calculation is pretty different. Whatever the present disqualified contribution, on that apply the rate of interest only for the half of the year. With that, you just add what about the disqualified amount of the previous year and the disqualified interest on that, both put together. For that, you have to apply the rate of interest. The rate of interest will not be given in your exams. How can you calculate? The difference between opening and closing value will be due to two reasons. One is the contribution of employer-employee, another one is interest on that. Employer-employee contribution, we can get it easily. So, missing data like you can calculate interest. Using that interest, you can calculate the average rate of interest rate. So, the interest divided by opening plus closing by 2 will be the denominator value. So, you can calculate the rate here is 11.1%. Is that clear? 11.1%. What about the year 24-25? Disqualified amount is 27,600. 17 class 2 subclass 7. Year on year the PF contribution is 7,77,600, which is excess by 27,600 is disqualified. Now what about the interest component as per the 7A? You have to go for applying the same. So here the disqualified contribution in the current year being 27,600 divided by 2. What is the rate of interest? The rate of interest 11.11 is nothing but previous year rate. Not necessarily same rate applicable in the current year. To find out what is the rate of interest applicable in this current year, you have to do the same process now for the year 24-25. What is the closing fund balance here? 46 lakhs. 48,555. Opening value being previous year closing becomes the opening for the current period 27 lakhs 43,048. Contribution in the current year being 7,77,600 by employer, equal amount contributed by employee, both put together the same will be available here 15,55,200. Opening value plus amount invested, both put together this much, and the closing value is 46, usually higher. That higher value is due to the interest earned here. The interest in this case being 3,50,307 divided by average investment, opening plus closing by 2. These two and average on this being 36 lakhs 95,802. Come on, get me the value in percentage. I think today's rate of interest, or current in years rate of interest being 9.48%. 9.48%. Today's disqualified amount is 27,600. For that applicable rate of interest being 9.48%, and as this contribution made over the year period slowly month after month, so you have to take the average. So by dividing 2 you will get it. Not only that, previous year disqualified amount. How much was the disqualified amount in the previous year? It is not previous year, previous years, right? Currently in the previous year we have only 127,600. If it is 10 years later, means all the 10 years 27,600 will be taken, or whatever the disqualified amount usually will be kept a separate account, so that the calculation may be pretty simple. So 27,600. And what about the total revenue on these things? In the previous year, the revenue being 1,532. 1,532. This will be available in which account? As per the disqualified account, in separate account. This portion up to 7,50,000 will be separately maintained. Beyond that, the 27,600 and 1,532 separately maintained. This 27,600 and 1,532, no, on this interest is recovered, which is at the rate of 9.48%. Okay, this amount available since the day one, so we calculate for the full year's interest. This amount is invested over the period, so we calculate only half year. Now, come on, what is the ultimate disqualified amount here? 4,069. So, 4,069 is the disqualified amount as per section 17 plus 2 subclass 7A. Okay. This value will be separately maintained. Which value? This 27,000 first year along with 1,532 in a separate account. Next year what happens now? Again with this account another 27,000 is added and 4,069 is also added. So the next year this value being 54,000 and interest on that being how much? Yeah. 5,601. So if you want to calculate the next year, actually not asked, that year also remains the same disqualified amount, then 27,600 divided by 2 into rate applicable by the time, plus the overall present contribution up to the previous year being 54,000 and total revenue on this contribution over the period being 5,601, and on that the applicable rate of interest for that period will be taken. That's how year on year it's calculated. But of course the sum seems to be pretty calculative, but in practical life no, everything is done by the machines. Okay, in computer that's how it is segregated and separately deposited, and automatically computer calculates and tells the disqualified amount. So automatically you have to pay the tax on this. Is that clear? Come on, make a note of it. Clear? Now, already we studied section 10 class 11 and 12 exemption portion. Okay. We have considered about the employer's contribution, right? What about the employee's contribution? In case of employee's contribution, also there is a restriction. There is a restriction. So, in case employee's contribution in a year in excess of 2.5 lakhs per annum, then that will be automatically taxable, right? From which date? On or after 31/3/2021. Not only that, interest on that amount also be disqualified. Interest credited on contribution of such person or employee taxable if the employee's contribution is beyond 2.5 lakhs. If employee contributes more than 2.5 lakhs, of course, never bother about the disqualified amount. Only the excess contribution carries interest, no, that interest is disqualified. Only interest. His own money he can deposit any number of amount, no issues. But it carries interest, no. That interest is taxable if the deposit amount is in excess of 2.5 lakhs. If you are depositing in the bank, what happens? If you are getting around 5% interest, that will be your income from other sources. Any interest you receive from the bank will be your income. But earlier, if you are investing in the PF account, it is exempted. To enjoy that exemption, you started depositing all the amount in PF account to cheat the government like. So immediately government has a check. You can of course invest, but you should not invest beyond 2.5 lakhs. If you are investing beyond 2.5 lakhs, interest on that excess amount will be considered as your taxable income under section 10 class 10 and 11. And of course, any other person, the limit is 5 lakhs. What about the any other person in case of PPF? In case of normal recognized provident fund, employee contributes 2.5 lakhs means the employer also contributes 2.5 lakhs, which is equal to 5 lakhs. But if I am not being the employee, if I am not employee, my name is any other person. If any person, my contribution could be employers, employees, both put together, my own contribution should be there, right? So the number is double, 2.5 lakhs plus 2.5 lakhs, 5 lakhs. In this illustration, I am going to incorporate that one also. Okay. Now, what's that? In the first year, 4,53,600 is invested. Beyond 2.5 lakhs, how much is there? 2,03,600. On that, apply the rate of interest applicable for that period, also be taxable. In the second year, employee's contribution also equal to the employer's contribution, which is 7,77,600. Only 2,50,000 is allowed, and beyond that 5,27,600. This is not disqualified. Interest on this is disqualified. Interest on this amount is disqualified. But in case of employer's contribution, beyond 7.5 lakhs is also disqualified. Interest on that amount is also disqualified. In case of employee's contribution, any employee's contribution not being a disqualification. But beyond 2.5 lakhs, any amount deposited, on that, interest extent is disqualified, not only interest extent. Interest on such a disqualified interest is also disqualified. Right, cumulative basis. Here, assume the rate of interest. For the simplified calculation, I assume the rate of interest being 10%. In the very first year, 20,360 is disqualified. In the next year, 5,27,600. Apart from that, this 20,360, for that also disqualified. Interest at the rate of 10%. How much is that? So, that excess amount carries interest, that is disqualified. Earlier year, that excess amount carries interest, disqualified. The excess interest is also there now. For that also you have to calculate. Again, disqualified amount. What is the value? 75,000? 73,120. That's how it will go year on year. So that information missed in PDF form, but it is given in Singar Academy text, page number 42. Note, as per section 10 class 11 and 12, interest on following will also be chargeable to tax during the assessment year 25-26. Yeah. So the details is given here. For the first year, anything beyond 2.5 lakhs, on that rate of interest is applied, that is disqualified. In the next year, 5,27,600 will be disqualified. And not only that, interest accrued on this also be disqualified. This is for the first year, this is for the second year. Is that clear? I think in text I have given 5 years details, right? So for fourth and fifth steps, the next year's disqualified amount is also given. Yeah. Yes. If you are clear, text me so that we'll move on to the next one. Now, so we have completed all. Some other tax-free perquisites also there in all cases. These are not taxable at all. Telephone, transport facility to employees by employer engaged in transport business if it is not being the specified employee, and staff group insurance, personal accident policy, non-alcoholic beverages during the working hours, lunch up to 50 rupees, recreation club were commonly provided to all the employees, and training of employees, some payable to RPF and superannuation fund, LTC to some extent, and medical facilities. All these things we already studied here. Group. Once the question is all about what are the tax-free perquisites are available, then you can give the list. That's all. We have studied everything. So relief under section 89. Relief under section 89. Already we studied the relief also in the very beginning itself. So in case of arrear salary and advance salary, previous year's salary put together, you are getting everything today itself. So it seems to be higher salary falling in the higher tax bracket. Unwantedly, you are paying the higher tax. So then there will be a relief. Of course, I have not added any illustration here, but it is available in CA as well as CMA material. I have published the videos already. Just go and watch that. So of course, practically it is not possible to be asked in the examination, right? On account of arrear and advance salary and even family pension, and no relief at the time of voluntary retirement or termination of services, right? Now let's start with the comprehensive questions, how we can expect from this topic. So I have given 3 questions here. We try to solve all the 3 questions. Let's start with. So we'll finish and we'll leave the class. Huh? Otherwise, you can try to solve that at your own home also, no problem. Which is better. We'll try, sir. That's why you also try in your own home, you're bringing the question paper from the examination hall out. Rather than solving in the examination, right? Okay. Comprehensive problem. We'll try to solve at least 1 or 2. Mr. Narendra, who retired from the service of Hotel Somod Limited on 31/1/2025. After putting on service for 5 years, received the following amounts from the employer for the year ending 31st March 2025. 1/4/24, retirement being year end being 31st March 25, retirement being 31st Jan 25. Almost in this current year, he has worked for 10 months. Salary 6,000 per month, comprising basic dearness allowance 3,000, city compensatory allowances. So basic being 10,000 into 10, 1 lakh rupees. DA 3,000 into 10 months, 30,000. CCA 3,000 into 10, 30,000. 2,000. Okay. Also taxable 20,000. Night duty allowances. 1,000 into 10 months, 10,000. Pension at the rate of 30% of the basic salary from 1 to 25. Thereafter, his pension being 30% of the basic salary, 3,000 only. Basic being 10,000 rupees. Out of that, 30% is 3,000 for how many months? 2 months. He has not commuted. So he receives 3,000 per month For 2 months, it is 6,000. Leave salary being 75,000 for 225 days of leave accumulated during 5 years at the rate of 45 days leave in each year. So 225 days leave received, leave encashment received. Disqualified number of days being how many days? Only 30 is allowed. So 15 days disqualified per year. Isn't it? So for 5 years, 75 days may be disqualified. So he is allowed only how many days? 150 days. 150 days salary will be allowable. Now come on. Leave encashment. Leave encashment received. The leave encashment received being 75,000. Whichever is the least is exempted. What is that? Leave standing in his credit multiplied by 10 months average salary, but nothing stated. So we assume the average salary is equal to the last month's salary in this case. Okay. So leave standing to his credit being leaves in credit multiplied by 10 what? Month. In case of gratuity, we will take calendar month. Okay, here 10 months average salary. Second one being 10 months salary. Third being yeah, actual amount. How much is the actual amount? 75,000. Salary for this purpose, we assume the DA being non-farming part of salary. It is an assumption. If nothing stated, you can assume. So you can take 10,000 only. Leave standing to his credit being only 150. 225, 45 days only allowed. In excess of that, in excess of 30 days. See, 5 into 45, 225. So he has not availed any leave during the service. He has not encashed any leaves during the service. The entire 45 allotted by the employer is there. So, but income tax norms prohibits to offer beyond 30 days. So only 30 days will be taken. So beyond that, 15 days per year disqualified. For 5 years, 75 days disqualified. From 225, 75 is subtracted. Only 150 days will be considered here. 155 divided by 30 into 10 average monthly salary is also the same 10,000 rupees. Then this value being 50,000. 10 months salary being 10 into per month salary being 10,000. So 1 lakh. So among the three, the least being 50,000 is deductible. Balance is taxable. The taxable leave salary being 25,000. So leave encashment. 25,000. Gratuity rupees 50,000. Gratuity. Right. Now we have to calculate the gratuity. How can you calculate in the case of gratuity? We can assume payment of gratuity are covered, not covered. In both the way you can assume. So what happens here? In case of gratuity, yeah, gratuity received being 50,000 minus whichever is the least is exempted. We assume payment of gratuity act not covered. That's what about your assumption? You can assume either way. So as per this assumption, number one being half into 10 calendar months average salary. 10 calendar months average salary, completed years of service. Second being limit, which is 20 lakhs. Third being actual gratuity. Right. So all these things you taught us a year back, sir. We could not remember all these things. Huh? So in case of taxation, you have to remember the day one's provision also today. Else it will not work for your exams. Be careful. Now, half into 10 calendar month salary, we have to take only the basic DA forming part as well as fixed percentage of commission. Here these two are absent, only basic will be taken. As the salary remains same over the year, we assume the calendar month's average salary also be the same 10,000 and completed years of service being 5. So then the value being 25,000. Among the three, the least being 25,000 is subtracted here. Balance 25,000 is taxable value. So gratuity taxable in this case being 25,000. Overall taxable value in this case being, come on, 2,16,000. You can now claim the deduction under section 16 clause 1A standard deduction. Under shifting of the default tax regime, only 50,000 is subtracted. If you add the default tax regime, 75,000 can be deductible. Okay. So I subtract only 50,000, assuming that he has shifted out of the default tax regime. So then the final taxable value being, come on, 1,66,000. This is gross salary. This is net salary for taxable purpose. Clear? Shall I move on to the next one? Are you copying the sum or not? Just watching, sir, how you are solving. If you are making any mistake, we'll find the fault. Fault finders. Make it faster. You have to work out along with me. Listen the lecture and work out, because already we covered all the provisions. Make it faster. Now let's move on to the next one. Okay, you can finish up copying this later. Now you join with me to solve this illustration. Finish up copying along with me. It's not copying, you can work along with me. As you know the provisions each and every one. Try to apply this. Mr. Raghu joined, listen, Mr. Raghu joined a company of Chennai on 1/7/24 and was paid the following emoluments. So he starts working from 1/4/24. Okay. For the previous year, we start with 1/4/2024, ends on 31st March 2025. He starts working on 1/7/2024 only. So during this period, he remains unemployed. Only this period we have to calculate the taxation. So 9 months he was working. Basic salary, come on. Basic. 50,000 per month into 9 months, it is 4.5 lakhs. Dearness allowance, 50% basic salary, eligible for retirement benefit, so DA, forming part of salary, which is 50% on this, 2,25,000. Furnished accommodation owned by the company was provided at Chennai. Okay, company owned accommodation. rent-free accommodation. In case of rent-free accommodation, if it is provided in Chennai, you have to consider 10 percentage. The population should be more than 40 lakhs, then 10% of salary. Salary for this purpose is inclusive of all cash benefit. So we have to wait for cash benefit calculation. Value of furniture. So furniture is also provided. So you know that for the furniture, you have to add 10% on cost as fringe benefits, 20,000 rupees. So if you add up these two, then you will get the rent-free furnished accommodations value. Rent-free furnished accommodation. Rent-free accommodation, unfurnished accommodation, you have to calculate separately. For that calculation, I need to know what is the mandatory cash benefit he enjoys. As I am not aware about that today, currently, so I'll just keep it pending. And fifth one, motor car owned by the employer. Motor car is the fringe benefit. It means perquisites, not forming part of the salary for the RFA calculation. So motor car owned by the employer with engine capacity less than 1.6 liters given for exclusive personal use. If it is used for personal purpose fully, then fully taxable. If it is for official and personal purpose, then there is a monetary limit. Okay, 2,400, 1,800 and chauffeur 900 will be taken. But in this case, it is for personal use, completely taxable. And self-driven by Raghu, expenses incurred by the employer on its running and maintenance being 55,950. The complete value will be taxable, 55,950. And then sixth one, educational facilities for 2 children are provided free of cost. The school is owned by the company, the tuition fee per month being 600 and 1,200. Education facility, education allowance is taxable, right? To the extent of 100 is exempted, beyond that is taxable. But in case of free education in the employer who owned the school, the tuition fee applicable for the similar brand school nearby will be taken as a valuation purpose. If that value is less than 1,000, is completely exempted. If the value is more than 1,000, completely taxable. So education facility. First case 600, as it is less than 1,000 is exempt. Second case 1,200, as this is more than 1,000, fully taxable. Okay, 1,200 per month. For 12 months, 14,400 will be the taxable value. Okay. Sorry, how many months? 9 months only, no? Calculate for 9 months. 10,800. 10,800. Now, annual membership for Gymkhana club paid by the employer. Club membership. Okay, club membership. What can we do? This 20. Okay, if it is specially allowed for him, then it is taxable. Okay. In case of salary for RFA, you have to take the basic, DA forming part of salary, and all monetary benefit will be taken. So basic being 4.5 lakhs, DA forming part of salary, yes, of course, the entire 2,25,000 will be DA forming part of salary. And this is also not considered as a monetary benefit. This is also not monetary benefit. This is also not monetary benefit. Only these two will be taken. So 6,75,000. And on that 10% will be considered as RFA value 67,500. So if I add up these two, then total value being 87,500. Okay. Of course, this furniture also 15,000. Make a correction here. 10% only allotted for 9 months, right? So 9 months, so 15,000. So do the addition of these two values. What's the final value? 82,500. Now, what is the overall value? This is called gross salary. Gross salary. Yes. Tell me the gross salary. 44,000 to, and this one is also be adjusted, right? Sorry, I made a mistake. 10% for 9 months. Property value should also be calculated for 9 months. Sorry, this I need to correct this one. Come on, make it faster. 50,625. The overall value being 65,625. Gross salary being 8,27,375. And of course, shift out of the default tax regime, you can calculate standard deduction under section 16 class 1A at the rate of 50,000 rupees. Then taxable value being 7,77,375. Clear? If it is clear, text me. We will move on to the last illustration. Now we'll move on to the next and last illustration. Clear? Raja joined TCA Limited on 1st June 2024. So 11 months only he worked in the previous year, leaving April and May. So 10 months he was in employment. So you have to calculate for 10 months. Start with basic salary. Basic salary 40,000 rupees for 10 months, it's 4 lakhs. And DNS allowance 15,000 per month into 10 months, 1.5 lakhs. Apart from that, he gets incentive also 30,000 per month for 1 year, 10 months only, 3 lakhs. Furnished accommodation at Mumbai belonging to the company is provided free. So, rent free, unfurnished accommodation. Mumbai, no. In salary, you have to calculate at the rate of 10% for 10 months. I am not sure with whether DA forming part or non-forming part. So, I will keep it pending. Will I need to include some other cash benefits are also, right? So, I am not aware about is there any other cash benefits, so keep it pending. Fifth one being motor car with engine CC less than 1.6 liters owned by the company along with the chauffeur for official and personal purpose. So, here furniture is also there, right? Furniture being 3 lakhs and on that 10% will be the value considered as fringe benefits for 10 months you have to calculate. 10 months, 10 by 12. What is the value? Okay. 25,000 and motor car 1,800 rupees as the CC capacity is less than 1.6. 1,800. If it is more than 1.6, then 2,400 will be taken. If driver is also provided, you have to add another 900 rupees for how many months? 10 months you have to calculate, the value being 27,000. Okay. Add this and post that outside. Okay. Salary of sweeper paid by the company 1,000 per month. Salary of sweeper. Okay. Sweeper salary. Perquisites. If employer is appointing, then that will fall under what? Taxable only for the specified. Anyway, this is a part of perquisites. 1,000 into 10 months, 10,000 rupees. Education provided for Raja's sons without any fee. Cost of providing education by the school is 750 per month. Okay. Education facility. As this value being less than 750, exempted. 8th, admission fee for corporate membership. It's a corporate membership. Corporate will be the member, employee can just enjoy being the employee of the corporate. Not taxable. Okay. Club membership fees. Being corporate, being corporate membership, exempted. Ninth one, house building loan rupees 10 lakhs was given by the company to Raja on 1st December 24 at an interest rate of 5% per annum. No repayment was made during the year. SBI lending rate being 10.75. If any interest-free loan is given or interest is charged nominally, then automatically it will be fringe benefits only. Okay. So loan at concessional rate. At concessional rate. Then the overall pending value being 10 lakhs throughout the period from the date of borrowing. The date of borrowing being 1st December, from 1st December 31st March of the next year, 4 months is there, so you have to calculate for 4 months. Applicable taxable interest rate being the difference between the interest charged by the SBI as well as interest charged by the employer. Come on, what's the value you are getting? 19,167. So as such, now we have only these three cash benefit. Now I assume the DNS allowance being forming part of salary. If you assume, then you can add up the three. Adding the three being 8,50,000. For 8,50,000 rupees, you have to calculate at the rate of 10% for 10 months. 10% for 10 months. 10 by 12. I correct here. Now what's the value? 1,27,000, isn't it? Come on, tell me. I'm not sure. 70,833. 70,833 will be the value. Then almost taxable value being, you add up these two, 95,833. Find out the total value. The total value in this case being 10,02,000 rupees. Gross salary. Gross salary. From that you can subtract the standard deduction at the rate of 50,000 if you are shifting out of the default tax regime. Shift out of the default tax regime. And taxable salary being 9,52,000. Clear? So with that, salary is completely over. So in practice session, salaries practice session, I asked you to solve the illustration from CA material as well as CMA both.